My name is Randall Liss, and I am here to talk about options with you. Today I want to discuss a pure volatility play, a play that involves out-of-the-money options, both long and short. That strategy is called the strangle, and we'll look at it from the long side and from the short side. What is the strangle? The strangle is long or short the out-of-the-money put and the out-of-the-money call in the same expiration month. Both out-of-the-monies are equidistant from the at-the-money. So we get something like this. Let's look at the long strangle. Let's say I think a huge move is coming in a stock or an index, but I really don't know which way it's going to be. But one thing I'm certain is we're going to get a move and volatility is going to pop. So I buy the out-of-the-money call, I buy the out-of-the-money put, same month, equidistant from the at-the-money. Looks like this. You see here, I'm long out-of-the-money put, strike A. I'm long out-of-the-money call, strike B. Where I can lose, my maximum loss, is what I've paid for the two. Well-defined maximum loss. Can't lose more than this. And my profit, potentially, is unlimited, whether we go up or whether we go down. Now that looks great, doesn't it? But remember, options are a wasting asset. They decay with time. Every day that goes by you don't get that move, your strangle is worth less. And don't forget, the clock ticks even when the market is closed. At night, weekends, holidays. Time decay ticks on, value erodes. So some people say, well, the heck with that, particularly if volatility is high. I'm going to sell both of them. I'm going to go short the strangle, in which case it looks like this. The most you can make is what you've shipped in. As long as we finish between A and B, you make that money on expiration. Of course, you're net short options. You're net short a call, you're net short a put. That means you have to put up a boatload of margin for one thing, and your loss is potentially unlimited. There's a lot of people who go back and forth on this. There are people who prefer to buy option premium because they say, I know what I can lose and I have great potential. And there are people who say, no, I want the clock on my side because 90% of options expire worthless. Now, I'm agnostic on this issue. I'm not recommending or advising either strategy. What I am is an options educator. So let's review the strategy called the strangle. Long or short, out-of-the-money call, out-of-the-money put, same month, equidistant from the at-the-money. The long P&L graph looks like this. You can lose what you paid, you can make whatever, but the clock is your enemy. The short strangle looks like this. You make money in between A and B. You make money every day that nothing happens. But if the black swan does fly, if the unexpected does happen, you have a great deal of exposure in either direction. So that's the strategy. It's called the strangle. Out of the monies. You can buy it, you can sell it. Thank you. My name is Randall Liss. My website is www.thelissreport.com. I write about options every business day. Thank you for your attention.